Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
The BC government has just introduced what they call an anti-condo flipping registry. Do you need to register the sales to stop flipping, and will it have any effect? Or is it too late?
Well, will it have any effect? I guess it'll make it a top-of-mind awareness item, Jim. I mean, it's just another situation where the government doesn't understand the tools that it already has at its disposal. The Canada Revenue Agency has not enforced flipping for decades. They have not enforced flipping because they haven't moved to check the contracts that are signed with the builders and then used to get a GST rebate, and with the names of the parties involved all included. Had Revenue Canada simply collected those for British Columbia, and had they reviewed them, it would take one single staffer employed during the year could be their full-time job. And they would still have time left over to do something else. Quickly go through those contracts and see who flipped the properties. Flipping is legal. It is always going to be legal, and it should be legal. What should not be legal is taking profits and not paying your fair share of your tax on those profits. The reason why flipping normally doesn't happen is because you can't make enough money flipping properties. And you can't make enough money because Canada Revenue Agency, generally speaking, has always followed up on this. But for some reason, over the last 5 years, that policy seems to have fallen the wayside, and they haven't seemed to do the follow-up work that you would expect would happen with any other asset class in Canada. So what you're having now is you have politicians trying to find a solution to something there's not a problem for. When you already have the existing laws, the existing paperwork, the existing methodology to find out who's flipping properties and make sure that they're taxed accordingly. Because you've got to remember, there's capital gains tax. And if it's a flip, it could be called a business tax. If there's business tax, that also means there's provincial tax payable. The GST is automatically no longer rebated. So with a new building, GST is applicable on a new build, but that GST is rebated through government policy. In order to get that rebate, a certain number of steps have to be followed, and then the builder gets the money back from the government, the GST credit. So if the government was doing the follow-up on the GST properly, when a flip happens, all of a sudden those GST rebates disappear. It's one of the main reasons, Jim, why a developer, up until about 2013, we went through probably a period of about 10 to 12 years in Canada, where pretty much every developer inserted a non-flip clause in their offers. And then what happened, I can't tell you why it happened because I don't know, but what did happen was those clauses gradually began to disappear, and by around 2015 they were pretty much gone. Builders were now openly allowing flips to take place prior to closing. So what you have here is you have a government reacting to a practice that people have participated in order to not pay their fair share of their taxes. Other government bodies have not followed up doing their job the way that they should. or they weren't even aware of it because the real estate community, wasn't reporting. Certainly, you've seen your foreign buyers not being reported with FinTrack. As another prime example, both developers and the real estate community. So you're bringing in a new policy here that is simply going to double up on what already is being done when all you have to do is collect it. This is no different than the vacant homes tax, Jim.
Right, but they'll create a huge bureaucracy to run it and waste taxpayer money.
Right, taxpayers have to spend more money. That means there's less money available for other programs. When the data is already available, all you got to do is have one person look through it.
Ross, we're almost 2 full months into the new year, and we're hearing Canadian banks and real estate brokerages saying the market is preparing to get busier again. Can we trust them, and is it?
Well, you know something? I think I've said in the show here over and again, you simply can't trust any commentary that is out there about housing and about markets. I mean, we just had there was a report on the internet that was available from a group who's consulted with CMHC. That report was available from the end of last week all through the weekend. I was made aware of the report today. And I looked at the report, and it was hilarious what this report said. It was commentating on home equity lines of credit, and it was mind-boggling that this report was out there. I think they had 40 some people had commented on it, and I looked at it and I said, "It's hogwash. It's nonsense. This report is false." Well, that report disappeared. It got scrubbed from the internet. It was gone today. So the moment we commented on it, it was taken down. Now, luckily, as I've said to your viewers here in the show before, what's different about this housing correction and all others is that Google and Google Cache is available. So we quickly went to Google Cache and found an old copy of the webpage. So we no longer have a page 404 error. We actually have the Google Cache had it stored. So that's what I think your listeners could take into consideration when they're listening to people commenting about the housing market getting busier. Remember, all of the commentary that they say this year, a year from now is going to be scrubbed or not looked at again. And there's nothing better than this specific phenomenon. Your listeners, if I asked your listeners, did you see anywhere in the newspaper that Ontario home prices last March had dropped $100,000? Is there one news article that was published in March of 2018 that said province-wide, all of the homes in aggregate together, their average selling price, as reported by Organized Real Estate, dropped $100,000? I can tell your listeners they should go out and Google it and see if they can find that headline. I have not been able to find one, when in fact, that is exactly what happened. When we look at a housing market, we go back in a historical perspective, and our main focus is back in the early 90s with the last major housing correction that took place. I mean, our little 2008 Great Recession correction was offset by mortgage debt. But back in the 90s, that did not take place. And we go back and we look at how organized real estate, the real estate brokerage industry, banks, housing analysts, CMHC, all of the people at that time were talking about the housing market back then. Well, in 1990, after I think about March or April, they started to announce that the housing market was slowing down in 1990. Where in fact the market had already been slowing down for a year. The following year, in 1999, as we're sitting at kitchen tables with families whose houses had dropped 20 to 25 to 30% in value in the last year, the Ontario Real Estate Association was reporting that the prices were up in March of 1991. They actually claimed prices were up 3.4% in March of 1991, while I'm sitting at table with people with houses 20 and 30% less. So what you are going to hear from the banks and the brokerages, sure, they're going to tell you that things are better, and they're going to compare it against last year. But as we've said in the show over and over again, when anyone has a house price chart that uses average selling price, benchmark price, MLS benchmark price, Internet National Bank house price index, the breakdowns in categories of homes in a city, and then produce an average selling price. These things don't measure what's really going on in a housing market. They never have. It's why, in March of 1991, in Ontario, while families had lost 20% of their home's value in a single year, organized real estate said prices have gone up 3.4%. That's not what happened. What happened was there was an onslaught of new construction builds that were being built of single detached homes. Those houses were being readied for a 1991 closing, spring of 1991 closing. In order for those houses to get sold, those large, brand new single detached homes to get sold, existing homeowners had to sell their homes. Well, those existing homeowners already owned more expensive homes, and they were stepping up into ultra luxury or into luxury class or executive class homes back then. That meant the homes that were purchased or available for sale had to have a substantial reduction, so that buyers who normally were buying a little bit lower category of home-priced home now could acquire these higher quality of homes in the same price category. Now, the real estate board said housing prices have gone up 3.4%. They said the same thing the month later in April when they said housing prices had gone up 3.9%. There was a sigh of relief across the market. Things were going to be fine. It was a false narrative. It was not the truth. The data that was available for anyone to look at clearly showed the housing market was still correcting. Except you have to look at all components of a housing market, not just one. If you see a chart that is produced with resale housing numbers, benchmark price, MLS HPI, Internet National Bank HPI, you can throw it out because it is only one component of the housing market. You have to blend all components together to come up with what's going on. So, if you hear any rumors, or you hear a bank, or a brokerage, or a realtor, or an academic saying that the housing market is stabilized, that housing prices have gone up year over year, it is a falsehood. It is not true. What they're doing is they're comparing apples to pears. This year's apples to last year's pears. It's not the same thing. You can forget about this quality-adjusted MLS benchmark myth. It is a myth. They're measuring bathrooms, how the bathrooms are changing month to month, how the bedrooms are changing month to month, how the furnaces are changing month to month, how the size of the lots are changing month to month. They're not measuring a quality-adjusted home. So, I think you very well could hear, hey, things are getting better. The same thing people heard in 1991, in the spring of 1991 in Ontario, amidst the greatest house price correction at that time we had ever seen. I suspect you could hear the same stories again in a couple of months ahead, while people are getting wiped out of their home equity.
We'll have more with Ross Kay right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Ross Kay. Ross, some analysts are claiming inventory is growing, and this is putting downward pressure on prices. Is that true?
I don't know where they came up with that one, Jim. We are at an all-time record low for the percentage of available to be traded housing stock currently listed for sale. So anyone that is claiming inventory is growing, it is growing at such a small level. And they're also trying to compare it against probably some regional market from a year ago or 2 years ago. And that's how they're claiming it's growing. These type of comparisons are the reasons you get a housing bubble in the first place, and you get a more severe downturn in the second. What I would say to your listeners who are listening, I would tell your listeners, I think today is the 25th, so I got to go back a week. So when I look back at my data for the 20th, so I look back at my data at the 20th. Within 200 homes, the number of homes for sale in Canada on February the 20th is exactly the same as the number of homes for sale in January the 20th. Now, what I'll tell your listeners is, even though the inventory has remained virtually the same and at all-time record lows, the houses that are for sale are not the same between January the 20th and February the 20th. And we use this kind of a demonstration. You go into a grocery store, and there is a table of beautiful red peppers, all laid out that they're trying to sell, they're laid out single row, beautiful, they're spotless. You go back in 2 days later, and you notice a few of the peppers have been picked over. You've got what's left, and you'll notice maybe a couple little spots or a little drying up of the pepper taking place. You go back in 2 days later, and all of a sudden, it's a beautiful display of peppers again. The ones that were started to wrinkle or had spots have been taken out and thrown in the garbage. The ones that nobody bought have been taken off and probably chopped off and thrown into into someone's cooking recipe. But you've got another beautiful set of peppers. Well, the number of peppers that are for sale now is exactly the same as they were a few days ago. It's a full stock. But between those periods of time, it was radically different what those peppers looked like. And this is what happens in a housing market long term. The properties, we call them stale dated on a market, which means is all the available buyers in a marketplace have looked at the property and they have determined the asking price is too high. Okay? So all of the buyers that are available in a marketplace, ready to buy a home today, look at the property that is listed for sale, and they all decide that home is too high priced to buy. So they don't buy it. A few months go by, and that house is removed from the market. Some will have a reduced price. Some people will realize the price in that property was too high, and they'll reduce it. That will drop it in price category. When you drop a home into another price category, the previous buyers that were looking at it may notice it, but what you're actually doing is you're offering that home to the next category of buyers, maybe ones that could only afford $20,000 less. When you're talking about inventory, what your listeners should understand is that a $20,000 difference in asking price on a property can determine whether or not that house is saleable. And it's not necessarily whether or not the house is worth that price, but more apt to be, can buyers qualify to buy it? Are the group of buyers out there right now the group of buyers who are qualified to buy it? And this is always at an imbalance in a housing market. So inventory claims really need to be super compartmentalized into different buyer groups. And these categories, Jim, really are very, very small and very precise. And what I mean to say by that is that, you know, the thousands of houses that I sold to buyers over the years, if a property was $5,000 more than what my buyer could qualify to pay for it, they couldn't buy that property. Even if that property was a fantastic deal, a way, way, way better deal than the houses that were priced that my buyer could afford to buy that were $5,000 less. My buyers simply couldn't spend that extra amount of money. Now, with today's interest rates, it might be a $20,000 spread. But that $20,000 is so critical to what a buyer is able to buy, and whether it puts that house into a different category where he can't even look at it or she can't even look at it. So when you're talking inventory level, this is one of the few items where you have to be very, very specific about a housing market. You have to look at, I'm assuming we're talking about home buyer search, you have to look at what price, maximum purchase price, you're qualified to buy at and you are prepared to buy at. I assume there's two differences, because the bank always overqualifies you for how much money you could borrow. That said, with B20, it's brought in a more prudent, and now it's giving homeowners a more rational choice, because now it's automatically constraining the maximum purchase price they're able to go to. But that said, you have to look at the price category that you're looking at, and then you have to look in the marketplace of how many available properties are available for sale that you could actually buy. And then from those properties, you need to rank them. You need to rank them 1 to 10, 1 to 20, 1 to 30, no matter how many are out there. And then you'll know which is the best house, which is the second best, third, fourth, and the worst. And then you need to track those properties for a while to learn the market. This may take you a few months for you to actually be tracking the price category of home that you're interested in buying. The problem we have right now, Jim, is because inventories are so low at the national level, all-time record lows, and that is because homeowners are fearful of the housing market right now. They are fearful of this ongoing housing correction. So they're not putting their properties on the market. So the problem for the buyer is with these low inventory levels, you are not seeing enough properties to be able to select from. That said, inventory levels are exactly the same on last Wednesday as they were on January the 20th of the month before. Inventories have not increased. And when we go back to December inventory, it has gone up maybe 4%. It is so far below historical norms, Jim, that the reason that we tell everyone right now is the most dangerous time to buy a house is because you have a correcting housing market across Canada, except for Quebec. You have the lowest inventory rates that we have ever seen, because inventory really should be measured on an activity level. So, I mean, it's a longer conversation we can have here on the show, but just trust me, your inventories are at a record low at a national level. Your selection, that means, is very small. The number of peppers that are on the shelf you're not seeing a full display of peppers. You're maybe only seeing half the number you should have. It is very, very dangerous time. And these claims that inventory is growing is a falsehood. There are around 182,000 homes listed on MLS.ca right now. Of those, there are about 174,000 that are actually the same single homes. They're because of the multiple counting of single sales on Realtor.ca. That is an all-time record low. Why would you want to buy when there's half the peppers on the shelf and the grocer is cutting the price because nobody's buying them anyway?
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, with so much attention being lauded on first-time buyers' affordability problems in B20, limiting their buying options, should first-timers look at waiting for the next federal budget before buying? There might be some goodies in there.
Oh, for sure, Jim. I think first-time buyers, anybody who's encouraging a first-time buyer to go, well, here's the sales pitch. Let me give you the sales pitch you're going to hear. You're going to hear banks and realtors and economists and academics saying, oh, if Morneau increases the amortization to 30 years, that's going to put more first-time buyers into the market. That's going to increase pressure on home prices. And so if you're going to buy, you should buy now before any changes are made, because you want to get ahead of any price pressure that will come in, would come into play. That's the story you're going to hear. That's the story you're going to hear because you've heard it every month for the last 30 years, being skewed in any way possible to encourage people to rush out and buy right now. Well, really, what you should be told is, if you're a first-time buyer, housing prices are falling, folks. They're falling all over. Condominium prices are falling. They're falling in Vancouver. They're falling in Toronto. They've been on this path for over a year. This path is not going to change. In Vancouver, in British Columbia, you had the $37,000 boost pulled from the market on top of that. So that means that Toronto is going to take a few extra months to catch up to that $37,000 differential. So, but that market is still correcting on the exact same path. These paths are precise. The only confusion I think that happens, Jim, is because that you don't know the starting point, and because the starting points are generally always different from BC to Ontario to Quebec to Alberta, the pattern maybe has not been able to be identified and followed. You know, that very well could be it. We count months, and when we count months, the pattern is exactly the same. It always has been the same. It has to be the same. So these first-time buyers who are probably going to be inundated, get out and buy now before the changes make houses more expensive. I would wait. If Morneau increases the amortization to 30 years, and that is going to immediately cause house prices to decrease. So let me say something totally different than what you're going to read everywhere else. Now, this decrease will be short-lived, 2 to 3 months. 2 to 3 months. Yeah, maybe 4 months. That's the pattern that happens, because first-time buyers may get invigorated and go out and buy homes. And if their share of the sales increases, the average selling price drops, because we are already in a correcting market. Where in the past, where prices were positive, growing, what first-time buyers did is they slowed price growth down. Now that we're negative, it will increase the negativity of the average selling price. Then, as the houses that they purchase, the owners from those houses move into the marketplace, all of a sudden, the average selling price is going to go up. And it's going to be reported in every newspaper in Canada, oh, the housing market's gotten busier. Housing prices have gone up. You're not going to hear the explanation I just provided because it's not taught to anyone in a post-secondary institution in this country. But that's how it works. And then on the third way, where the next trade happens, the average selling price goes up again. What your first-time buyers should really think about, we look at it as an hourglass. So you can at the start of a trading cycle, the top of the hourglass is filled, and that's your first-time buyers. Okay? Those first-time buyers work their way through the market. And those first-time buyers cause the bottom of the hourglass to start to rise. A pyramid forms, which is house price. And at the end, when the first-time buyers are still able to fill that hourglass, there's still grains of sand running through. The very few last grains of sand end on the top of the pyramid. And that is where you get peak house price growth. That happens for 1 or 2 months, and it disappears. And I think that's exactly what happened in British Columbia in March and April of 2016. I think that's exactly what happened in Toronto in 2017. I think that's exactly what happened in Calgary back in the end of 2013. In 2013, that's exactly what's going to happen in Quebec probably this year, probably 2018. So when the grains of first-time buyers are emptied out of the top of the hourglass, the housing market slows down and dies. That's just what happens. And you've got to wait for those first-time buyers to refill. You've got to wait till the top of the hourglass gets refilled, and while it's being refilled, the bottom of the hourglass, someone's shoveling out the sand out of the bottom of it and getting ready to start all over again. And that's how a housing market works. So, first-time buyers should be waiting for this buying opportunity to arrive. Now, my only problem is this. This is not going to be a true buying opportunity. You're going to hear that housing prices have dropped. So right now you're probably going to hear they've gone up, then you're going to hear that they've dropped if Morneau makes changes to the budget. They really haven't, folks. All it is a shifting sales mix. A shifting mix of buyers buying in a given month. And unless you're able to record where those buyers are and what they're buying and why they're buying, you have no idea of what's actually happening in a housing market. And then 2 years later, when you're reading the news headline, you're reading what actually was being recorded those 2 years before, when the grains were falling through the hourglass, the pyramid was being formed. It's a natural progression. First-time buyers should certainly wait and see if there's any incentives in this next budget in the middle of March. I can pretty much guarantee there will be incentives of some sort.
Sure, it's an election year.
Yeah, that's exactly right.
Bribing you with your own money.
Yeah, and then those first-time buyers need to step back and understand the consequences of those changes. They need to sit down with a piece of paper and with the right information and go through their next 25, 30, 40 years of life. And then they should look at a reality check. And let's end today's show with this reality check. I don't think you will find a single academic, realtor, broker, blogger, analyst in Canada who believes Ontario home prices have gone up more than British Columbia home prices. I don't think you'll find anyone who is on the record saying that. Yet we would tell you that home prices in the province of Ontario have increased more than they did in British Columbia. Because we measure housing markets differently. You need to go back more than just a couple of years. Go back, all of your listeners. If you're questioning what I'm saying, go back and look at the average selling price in December of 2011. December of 2011 in British Columbia. Look at what the average selling price is. Then look what the average selling price was in December of 2017. Now do the same thing for Ontario. Housing prices in Ontario increased 33% more than they did in British Columbia. 33% more. The British Columbia prices increased about $150,000. Ontario increased over $200,000. $50,000, 33% more than British Columbia. Find that printed anywhere. This is probably the most frustrating thing for us, Jim. We have to spend so much time and effort with people to try to get them to look at the data, look at the numbers, look at the facts differently, because they're constantly inundated with false metrics. There was no question that British Columbia was called the biggest housing bubble in the world. Yet at the same time, Ontario had a 33% greater house price change since 2011. I mean, what planet am I living on that all of these economists, all of these academics, the banks, the Bank of Canada, the politicians, can't simply pull up the data, even though it's flawed, right? It's organized real estate data. It's flawed. But you can certainly use it for 5 to 7 year windows and not be making huge mistakes. Certainly not a mistake where you would call Vancouver the hottest housing market in Canada, when in fact British Columbia was 33% lower than the house price gain that was ongoing in Ontario. And the only reason that your false house price illusion maximized in 2016-17 was because the way the benchmark price works and the foreign buyer content that we're buying, that we're assuming a larger share of your market. The truth is, from December of 2011 till December of 2017, house prices in Ontario had increased 33% more than they did in British Columbia. Before you're buying, please seek out some real information. Don't look at it from a year-over-year perspective, a 2-year-ago perspective, a 3-year-ago perspective. Look at it for a 25-year perspective. See what your gain over 25 years should be. Lay out what the cost of that home is going to be for you over those 25 years. What kind of a job you're going to have to afford that. Look at the maximum monthly mortgage payment you may have to pay at some time during those 25 years. And are you going to have a job that would allow you to be able to pay that maximum mortgage payment? These are the decisions that first-time buyers should be looking at. This is why the generation squeeze nonsense that has been ongoing out in British Columbia. All of the academics that have been commenting about the housing market out of British Columbia. That doesn't happen in Ontario. You don't get academics commenting about a housing market. First-time buyers need to get some real, hard data. Sit down, make a rational decision. Certainly wait till after the budget happens. And I'm going to be telling you, first-time buyers, just keep saving your down payment, because when the window opens to buy, you're going to have saved so much more money. You are going to be in so much of a better starting position that 25, 30, 40 years from now, you are going to be far wealthier than if you did.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter at House Street, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.